Hi, everybody, and welcome to our mortgage trend series. As some of you guys have probably joined us before, this is a quarterly series where we talk about the latest trends that we're seeing in all of our various capacities and services that we do at Richie Mae. So I'm Eliza Berry, Marketing Director, and I'm basically just going to take you through a couple of housekeeping items before we get started. This webinar is being recorded. You're more than welcome and highly encouraged to ask questions either in the questions channel or the chat screen. I will be monitoring that throughout the presentation, and I'll field your questions to the presenters. If you get it in while we're talking about something specific, then I'll just pipe up and ask that question right then. Otherwise, we'll address each question at the end, and then if we run out of time, I'll start an email chain with the email you registered with, and whichever of our speakers or internal subject matter experts can help you out. So don't hesitate to ask those. Along with the recording, you will get a copy of the slides that we have today. Usually that comes out in 1 or 2 business days, so you should see it by Friday. And there will be a quick survey after the webinar. I'll remind you at the end, it's only 3 questions, I think, 4 questions, and they're mostly yes or no. So if you answer that, it really helps us tune this webinar to your needs. So with that being said, we have 3 presenters today. At the end, I'll just go in reverse order. At the end, we'll have Jason Hamilton, our Director of Cybersecurity Services, talking about trends in cybersecurity and kind of the state of the union of cybersecurity that we're in right now for our industry. We'll have Olivia Nicholson talking about all of our business intelligence and analytics trends that are coming out of our Richie Mae Select and peer view ops data that we collect from that peer-to-peer benchmarking data. And then I'm going to pass over the mic to Mignon Davis. She's our internal audit manager, and she's going to be talking about some trends in compliance and internal audit that are going to impact the industry as a whole. So whenever you're ready, go ahead, Mignon.
Okay. All right. Let's see. Okay. Thank you everyone for joining us today. My name is Mignon Davis, and I'm going to speak to you today on the CFPB emphasis on mortgage servicing, Regulation F, the final rule, which is effective November 30th, 2021, state regulators, and Fannie Mae requirements for compliance management systems and internal audit. So let's just dive right in and talk about the CFPB. Let's see, I think we're on the wrong slide here. Oh, yeah, yep, that one. Okay. All right, so we know the CFPB has been scrutinizing mortgage servicers due to the pandemic. Nearly 750,000 active forbearance plans were set to expire in September and October, which means servicers processed up to 18,000 plans per business day during the past 2 months. And we also know that the CFPB's acting director has said that there could be serious consequences for those servicers that do not comply with the regulations. So we know that they mean business. The CFPB issued a report on August 10th, 2021 called Mortgage Servicing Pandemic Response Metrics, where they show observations from data reported by 16 of the largest servicers. The results indicate that mortgage servicers' pandemic responses varies significantly. So the CFPB expects servicers to compare the metrics published in this report with from these 16 servicers to their own internal metrics to identify opportunities for improvement and demonstrate concrete efforts toward improvement. So here's what they found. Call metrics. Some servicers in this report kept hold times for borrowers under 3 minutes, and others had hold times as long as 26 minutes. Average speed time to answer, hold times, and abandonment rates are all key metrics that servicers need to be watching. Forbearance exit metrics. This data was reviewed to determine the level of support servicers are providing borrowers as they transition out of forbearances. Many servicers saw increased delinquent exit rates, which means there was no loss mitigation plan in place for the borrower when the borrower exited the forbearance. This is an indicator of lack of support for borrowers by the servicer. Delinquency metrics. Overall delinquency rates range from about 1% to 26% for both federally backed and private loans. The CFPB urges servicers to compare their internal metrics with what's going on in the industry. Servicers will want to be on the low end of that range of 1% to 26% on those delinquency metrics. Borrower profile and limited English proficiency. Nearly half of the servicers in this report stated they do not collect or maintain language preferences for their borrowers, which may lead to borrowers not receiving needed language assistance. Some servicers also stated they do not maintain borrower race, which could lead to fair lending violations. Historically, servicers have not collected or maintained this information about their borrowers, but it is clear that servicers need to develop processes for this and to review this information about their borrowers periodically to identify and monitor trends for fair servicing. Pandemic assistance enrollment metrics. This metric tracks the type of assistance offered to borrowers and tracks which offers were accepted and which offers were rejected. So again, the CFPB is urging servicers to compare their internal metrics with those reported here and to identify opportunities for improvement and demonstrate concrete efforts towards improvement. Okay, going back a little bit in time here, April 1st, 2021, the CFPB put out a bulletin where they clearly outlined their expectations for servicers to resource their loss mitigation activities appropriately, and they urged servicers to dedicate sufficient resources and staff. They also listed some other areas that they would be focusing on: providing clear information to borrowers about options for payment assistance, adherence to Reg X for proactive borrower outreach, adherence to ECOA. And again, they talk about fair servicing for limited English proficiency. This keeps coming up, so this is definitely a focus. Also, fair servicing for income derived from part-time employment, alimony, child support, public assistance, and a few other types of income were listed in there. Customer service and telephone hold times, which we just discussed a little bit with the call metrics. Single point of contact, or that continuity of contact. Timely and consistent loss mitigation evaluations. Adherence to Reg X, foreclosure protections, and other federal or state protections. And also Fair Credit Reporting Act. So again, these items are on the CFPB's list of things to focus on. Okay, on top of all the scrutiny the CFPB is placing on servicers, there's also new FDCPA regulations underway that have been keeping servicers busy the past few months as they navigate through the new requirements and work to implement new processes and procedures in order to be ready by the end of the month. So Reg F, the final rule, again, it's effective November 30th, 2021. And some changes are going to be in effect for the following areas: call frequency restrictions, limited content messages, including voicemail, time and place requirements, reasonable procedures for email and text communications, where servicers will be required to maintain procedures that are reasonably adapted to avoid errors in sending emails or text message communications to borrowers. Requirements for providing legally required disclosures electronically and must also comply with the e-Sign Act as well. Translated disclosures. Again, here we see this limited English proficiency requirements for disclosures. Servicers are going to need to make those disclosures to the borrower in the same language or languages used for other communications for that borrower. So again, tracking the borrower's language preferences is going to be very important going forward. Also, changes with regard to mortgage-specific validation notices. So servicers have been all hands on deck between their compliance functions and IT departments so that they could work together to code systems and update communications for borrowers and comply with these new requirements. So servicers have been very busy dealing with forbearance exit plans and this new FCCA rule that's coming out. Okay, now switching gears to state regulators. State regulators are increasing the number of companies they are auditing. With more states opening up and auditors returning to offices, Richie May has heard of a number of companies being notified that they've been selected for an audit. I think we're on the wrong slide. Let's see, go back. Yep, that one. Yep. So California in particular continues to scrutinize lenders' compliance with strict escrow requirements, including placement of escrow funds, where all upfront escrow amounts are to be timely deposited into an escrow or trust account. Escrow cash accounts, where the funds are to be placed in a non-interest bearing account and clearly labeled as an escrow or trust account and are segregated from operating funds. No debit balances are allowed in the loan level liability accounts. California disclosures, in particular the Fair Lending Notice, must have the correct name and address for the Department of Financial Protection and Innovation, the DFPI. Also, per diem interest on California funded loans needs to be calculated correctly to ensure interest calculations are not in excess of the amount permitted by the California Financial Code. Okay, now let's talk about Fannie Mae requirements for compliance management systems and internal audit. Next slide, yep, that's it. Margin calls last March created a lot of chaos in the industry, and lenders applied for Fannie Mae approvals in record numbers. Now, lenders are working to maintain or develop compliance management systems and internal audit functions, whether they're staffed internally or outsourced to a third party. So let's first talk about compliance management systems, and then we can talk about internal audit. An effective compliance management system has two interdependent control components. The first is board and management oversight. Now, this is where the board and management demonstrate clear expectations about compliance, appoint an experienced chief compliance officer, allocate resources to the compliance function commensurate with the size and complexity of the organization. The second control component here is the compliance program itself, which includes policies and procedures, change management controls, which includes tracking decisions and changes, training designed to be borrower focused and to mitigate borrower harm, compliance and control monitoring and testing. This is documenting controls and performing quality monitoring and testing, and that testing schedule and coverage should be appropriate to the size of the organization. Issue resolution and corrective action. Corrective actions should be timely and fully address the issues. Consumer complaints. Respond to borrowers timely and fully resolve their complaints. service provider oversight, which includes initial and ongoing due diligence reviews, ongoing monitoring reviews, and to ensure that service providers are complying with federal consumer financial laws. It should also include procedures to take prompt corrective action to fully address any problems identified through the monitoring process, and should also include a process to terminate the service provider relationship when necessary. Okay, after reviewing compliance management systems, now let's talk about internal audit. Building a strong internal audit function. First, it's important to conduct a risk assessment. Fannie Mae requires an internal audit plan or schedule that is risk-based and updated annually. This is accomplished by beginning with a risk assessment to evaluate and categorize the risks of each department, and then apply a risk rating for each of those key process areas. Next, we're going to develop an audit schedule or plan. And you're going to build this schedule from the risk assessment using those risk ratings that were assigned to each key process area. And this ensures that higher risk areas are audited more frequently, in particular on an annual basis. Also, include a process to review the audit schedule periodically and adjust it when necessary to incorporate for new and emerging risks, changes in the industry, or changes in the functional area. The next step is to conduct audits and review the findings with senior management and the board or the audit committee. It's very important to establish a framework of communication and collaboration between the internal audit function and the business units to assist the business units as they build the control environment. Now, what can lenders do today and servicers to develop a compliance management system and an internal audit function? The first thing would be to decide if you have the resources and skill set internally to develop the CMS or the internal audit function, or whether you need to outsource parts of those functions or all of the functions. Next, identify your lines of defense. How strong are they? What can be done to strengthen those lines of defense? Documenting policies and procedures to prepare for the risk assessment is going to be the next step. Have each business unit take inventory of the automated and manual controls in their department, such as system hard stops, second-level review processes, and exception reports. Then you're going to gather those policies and procedures into a central location. If you've already done this, then review those PMPs again and update them as necessary. Following these steps will help you prepare for the risk assessment and the subsequent audits. Now I'm going to hand it over to Olivia to discuss benchmarking trends in operations and finance.
Great. Well, thank you, Mignon, and thanks again, everyone, for taking the time with us today to go through some of these trends that we're seeing. Just a reminder for everyone, I'm Olivia. I'm the Director of Business Intelligence and Data Analytics here at Richie Mae. So my team works both on Richie Mae Analyze. Remember, that's our customized business intelligence solution we kind of built and customized specifically for mortgage companies. And then we also have a number of benchmarking products. One of those is Richie Mae Select, which I'm going to be talking about today, and that is our quarterly financial benchmarking and peer comparison program. So with all of these tools, we have some data and some trends that we're going to go over today, so you can really see what's happening specifically in the areas of operations and finance. So on the next slide here, I have a report for you. This is from Richie Mae Analyze. So this data is compiled through our clients' LOS systems. This report specifically is showing you some trends in turn times over the last 22 months, so since the beginning of last year, 2020. The report is showing you application to fund turn times. These are all in business days, and these are averages across a number of our clients on the Richie Mae Analyze platform. So I have these turn times broken out here by time from application to submittal. Those are those green bars on the bottom. Submittal to final approval are those orange bars in the middle. And then on top there, those red bars are final approval to funding. So like I said, these are all in business days. Obviously, every company is going to kind of dictate their own company holidays. So this is just going to give you an idea of how many days worked it is taking to get these loans through the pipeline in total. So I've talked about this over the last couple quarters. I'm sure you're all well aware, you've been living it, but we saw some pretty dramatic increases in turn times, pretty much across the industry throughout 2020. So on the left-hand side of that graph there, you can see we started off 2020 at about 30 business days on average from application to funding. We even dropped down to about 27, 28 business days in those first few months of the year last year. But then just as production kind of overwhelmed the system, those turn times rose pretty dramatically through the year, almost 10 business days by the end of the year last year. So since then, there have definitely been some improvements. I mean, we can see we're slowly trending in the right direction for the majority of 2020, especially in that application to submittal timeline, those green bars on the bottom. But we have been pretty flat for a few months now, and it looks like we even ticked up by a couple of days on average over the last couple of months. So, actually we've you can see that really is, attributed to that underwriting turn time. So those orange bars there in the middle, it looks like those have actually been slightly increasing over time, even when we were kind of seeing some improvements elsewhere at the beginning of the year. So definitely something to keep an eye on there. Even explore some options maybe for improving your underwriting efficiency if this is a problem that you're facing right now. Looking at your processes, your staffing, maybe even exploring some automations options there in underwriting as well. So on the next slide, just as a reminder, if turn times are something that you're struggling with, or you just kind of want to know where you stand in comparison to your peers, we do have production and operational benchmark reporting available through PeerView Ops in our Richie Mae Analyze platform. So this is going to allow you to see where you stand on a number of metrics, including the turn times reporting we have right here. It's going to compare you to a number of peer groups we have out there, so you can really drill into where you're an outlier, understand what changes you need to make there just to kind of get back on track in terms of where you're sitting in relation to the industry. So all of this is live reporting. It's pulling in data from your peers and from your LOS once a day, so you don't have to fill out any surveys or wait for any quarterly data. You really just have that data updating automatically in the platform for you to dig into whenever you need to. All right, so on the next slide, this benchmark reporting we have is really a good segue into another benchmarking program that we have. So that's Richie Mae Select. Like I said earlier, Richie Mae Select is our financial benchmarking program. We have over 70 IMBs participating in the program, and they are able to see their quarterly financial data compared to their peers. So I'm going to go ahead and show you some of the data, get into some of those metrics and financial trends, but just to give you a high level idea of what we're going to see here. It's kind of funny, I'm kind of excited to show you guys this quarter because I feel like the last 3 quarters it's been all doom and gloom and having to tell you about these huge drops we're seeing in production, drops in gain on sale and your net income numbers. So even though I do have to report still that we are seeing some declines in the context of kind of that huge roller coaster drop we've seen over the last few quarters, this quarter actually looked pretty steady. So in this chart you're looking at right now, we're jumping into some of the origination trends that we're seeing through participants in the program. All of the data that I'm showing you in all of these charts today, this is our entire Richie Mae Select population. So you can kind of see what these trends look like in total. For this report, I'm just showing you a view of the last 5 years, so back to the end of 2016. And I'm showing you average quarterly production across that participant base. We're showing volume in millions here. And keep in mind that as you're looking at all of these charts and numbers, everything I'm showing you today, this is our entire participant base. So this includes companies of kind of all different sizes and channels if you're doing any comparisons yourself. So as you can see, that production came down just a little bit in Q3. It was down about 3% compared to Q2 on average. But as we've been saying the last few quarters, this is historically very high still. It's actually 1.6 times what we saw as our previous quarter high before 2020, and that was in the 3rd quarter of 2019. So It might not feel like it, as we're living it and still kind of dreaming about the numbers and production we saw last year, but as you can see on this graph, our production is still looking very, very high. And also on this graph, another trend, or I guess kind of lack of trend this quarter, is that the refinance share stayed pretty steady this quarter. It dropped to 34% this quarter from 36% last quarter. It was at about 50% for all of 2020. And it actually dropped last quarter pretty dramatically down to that 36%. So we're back at the levels that we were seeing towards the middle of 2019, so kind of recalibrating there. So that's what production looks like. On the next slide, we're getting into some of the financials. So the first piece I'm going to talk about is net production income. If you're not familiar with Richie Mae Select, the reports that we provide through the program are net production income, servicing income, and then also your GAAP net income. And this net production income number is really intended to show you the profitability of your originations. So revenues that we would be including here, any of your secondary origination fees, your warehouse spread, and then your expenses are simply just all of your kind of costs to originate there. So this number will not include any of your servicing activity. We will also be excluding here your unfunded locked pipeline or loan loss reserves, or any activity kind of not related to originations. So really intended to kind of give you an apples to apples comparison of where your origination profitability sits each quarter. So the averages here, we see that net production income is down about 6 basis points, which is about 6% from Q2 to Q3. That actually seems, again, pretty steady in the context of other quarterly changes this year. We're sitting at about 90 basis points on average. Keep in mind, again, that like origination volume, kind of as I'm throwing out numbers here, this number is still pretty high, so keep that in context. It is still the highest non-2020 net production income that we've seen since 2012. So for a little bit more context on this report, I zoomed out this chart compared to the last one when we were looking at production. So this chart is actually showing you back to Richie Mae Select program's inception in 2012. So you can kind of see how this quarter's net production income compares to prior periods. We're kind of hovering right around those numbers we saw in 2012, parts of 2015, 2016. But still historically, especially when you're comparing to some periods in 2014, 2017, 2018, we're looking still pretty good in terms of that net production income number. So on the next slide, I'm going to start to get into some of the numbers behind that net production income. First, I'm going to touch on secondary gain on sale. So obviously that's going to play a significant role in your net production income number. This is going to be the largest driver a lot of the time in your net income or net production income. But before I get into these numbers, just before I give you raw numbers to kind of think about and compare to your own, just want to remind you that these are averages across the entire population. So there's a combination here of channel mixes, different company sizes. So just kind of keep that in mind, depending if you're more on one end of the extreme or other in terms of retail versus TPO, or if you're particularly large or small, your numbers aren't going to, obviously compare exactly here. And just another quick note, if you are comparing, we do not include the unfunded locked pipeline gain or loss in these numbers, so make sure you're excluding that as well. So with that, you can see that big peak that we had in these gain on sale margins late last year. And then very similarly to the net production income chart, we took a big hit to that momentum in Q1 of this year, and then another drop, much smaller drop in Q2, and then another even smaller drop this past quarter. But again, looking on the bright side, this is still high in that historical context. I kept this one zoomed out again, so this chart you're looking at since the beginning of 2012. And we're now right at the same level as our previous peak before 2020, which happened in 2017. So that's your big revenue driver with gain on sale. On the other side of that, on our next chart, I want to take a look at cost to originate, so kind of the expense side of things. So the way that we're measuring cost to originate is just summing up any expenses on your financial statements. We're going to pull out anything related to servicing because that's included on our servicing income numbers, and we want to, again, get you that apples to apples comparison if you're not a servicer. And then in this case, we're just looking at cost per loan. So we're dividing that total expense by the number of closed loans in the period. So those costs went up again this quarter on a per loan basis. That's obviously not surprising given that production is down a little bit. So a lot of those fixed costs are being allocated across a smaller pool of units. But I do want to point out that this was actually a decrease in cost to originate when you're looking at it in basis points. Just as average loan balances have been kind of increasing over time, that basis point number is actually dropped. So this per loan analysis we're looking at, cost to originate went up, but if you're thinking about it from a volume perspective, that has gone down. So the all-in cost to originate, that is up $157 per loan this quarter. That's from increases in both personnel-related expenses, which are those blue bars on this chart, and then your operations expenses, which are those green bars at the top. On the personnel side, an interesting note I had here is the cost related to your sales personnel. So your loan officers, account executives, sales management, sales support, those costs all increased by $117 per loan, but all other personnel costs, so any of your fulfillment and back office groupings, those decreased this quarter. And then on the operations side, which is all of your fixed costs, so your rent, occupancy, your equipment, any of your general and administrative costs, those went up about $45 per loan this quarter, really, again, just because those fixed costs are being allocated across a smaller pool of loans. All right, so last slide on our benchmarking data, kind of taking you out of the financial realm and looking at some efficiency metrics. So Richie May Select also has some personnel reporting to kind of help you understand both your total headcount distribution compared to your peers, and then also how efficiently you're able to use that headcount by looking at some closed loans per employee tracking. So this is showing you closed loans per FTE. That FTE stands for full-time equivalent. So this is simply a calculation just of how many loans were closed over the quarter per staff member on your payroll that same quarter. And the FTE is where we're accounting for employees who started or left, partway through the quarter. Again, just so you have an apples to apples comparison there. So I'm showing you a 5-year view here. On the left-hand side of that chart, we're starting at the end of 2016 all the way through to Q3 of this year. I've broken this out by sales employees, which are your blue bars. We have fulfillment employees in green, and then back office are those orange bars in there. So you can kind of see how many loans per each of those groupings you're closing each quarter. So you can kind of see overall trends as expected. They're following those production trends. So we were getting a lot of loans per employee last year as production started to peak, and have just been steadily decreasing since Q3 of last year. In total this quarter, for all employee groupings, we dropped from 2.17 closed loans per FTE to 1.95 closed loans per FTE from Q2 to Q3. So what I thought was interesting here is actually we're right in line or even kind of below where the loans per FTE numbers we were seeing in 2019. And that's despite our recent production numbers that we just went through being still quite a bit higher. We said 1.6 times what they were back then in 2019. So it's just kind of interesting to see how these numbers change over time in ways that aren't, always directly proportional to production, just kind of based on other factors at play. So it'll be interesting to see if or when the industry can kind of recalibrate when it comes to staffing and some of these productivity metrics, just after all the changes we've had over the last year, obviously with production increasing, but also just thinking about getting used to remote work and the workforce just kind of changing in general. So that is what I have for you this quarter on our operations and financial metrics. We'll definitely be keeping an eye on all of this. Interested to see how some of these trends continue or if any of them kind of start to go the opposite direction anytime soon. But with that, I'm going to pass it over to Jason to talk about some of our cybersecurity trends.
Thanks, Olivia. So I'm Jason Hamilton, Director of Cybersecurity Services here at Richie May. And let's talk about, we're going to switch gears a little bit and talk about security. So what is cybersecurity? Security professionals talk about this triad of confidentiality, integrity, and availability. These things are, confidentiality is making sure that the data we protect is only available to authorized users of that data, that it's accurate data, that the integrity is maintained from end to end, and that it's available for your business to use. And the way that we protect that data is through our people, our processes, and our technology. All three of those things have to work together to make sure that we protect the data with respect to those building blocks of confidentiality, integrity, and availability. With those three foundational principles, if any one of those falls, it's a domino effect. So the reason that it seems like such a challenge to implement a security program that protects you against cybersecurity attacks is because we have to protect all three. If just one of them is compromised, our whole security program falls over. So what kind of data are we protecting? Really, we're talking about information, right? We're talking about non-public data, non-public information. And that's the umbrella, the broad term that we use to describe PII, personally identifiable information. That's the one you're probably most familiar with. That's people's names, addresses, social security numbers. And then you've got financial data, health records, all these different buckets of types of non-public or confidential information. That's the stuff that we're trying to protect and keep out of the hands of threat actors and hacker groups. PII is probably not protected as well as credit card information and health records in most environments. And turns out IBM reported in their 2021 data breach report that PII is actually the most costly record to lose, right at $180 per record. The rest of them average about $161 per record to lose. And does add up very, very quickly. Let me see. Next slide, please. So losing all this data has a significant financial impact on your business, and it's not just the fines that you may incur from some regulatory body. There's lots of different costs associated with losing records. You can lose productivity while you're trying to recover. If your systems are taken down by some kind of denial of service attack, there are costs to notify consumers. A lot of privacy laws require that you send out notifications that their data was lost, that you provide credit monitoring services, and of course there's going to be loss of revenue associated with the reputational impact. These costs, it kind of goes up and down, but the overall trend is upward, and it's spiked pretty considerably here from 2020 to 2021, rising $380,000 just in the last year. That's the overall global average, which comes to right at $4.25 million on average. Remote work. So with the pandemic, we've had to face down some challenges with moving to a remote and hybrid workforce and how we protect the data. I've spent most of my career in security ops. I've always been held to this mantra of do not let the data leave the data center. So that references to an on-premise facility where we've got all of our servers in one central data center, and it's becoming a bit antiquated. But what it means is, it's still applicable to say do not let the data leave the ecosystem of control. And that is, we've got all this cool technology in place to make sure that we're protecting the data that we've been entrusted with, and we need to make sure that extends to this remote workforce model. One of the latest interesting statistics I found is that the cost of a data breach is actually $1 million more expensive when there's remote work involved. Additionally, you've got folks outside the office that are susceptible to social engineering and manipulation through phishing and phishing. Phishing being over the phone and phishing coming in the form of email. That's one of the most effective attack vectors, and it's going to continue as long as it's an effective method of attack. So let's talk about vulnerabilities. How are these attacks coming in? Back up one for me. There you go. The window of exposure. This is the metric that we track to see how long a vulnerability, a severe vulnerability, could be available to the internet or available to the public and exploitable. The efficiency or the time that it takes you to patch a vulnerable system is a pretty important metric. So there are roughly 40% of financial applications available on the web today that have a window of exposure of more than a year. That's more than a year that we've given to hackers and these hacktivist groups to just kick back and take their time and find a way to exploit those vulnerabilities. On average, it takes 246 days to fix a severe vulnerability across all industries. Finance and insurance industries are a little bit worse than that, taking 286 days on average. The fact is, these severe vulnerabilities in these business critical systems are just not being addressed as quickly as they should be. And this leaves a window of opportunity for threat actors to exploit those vulnerabilities at their leisure. So you guys, next slide, please. You guys have heard of software as a service and desktop as a service, infrastructure as a service. So now ransomware as a service is a real thing. These attacks are becoming more sophisticated by these hacker groups. Criminal organizations like DarkSide, the Russian hacker group that perpetrated the ransomware attack on Colonial Pipeline earlier this year, the one that had people filling up plastic bags with gasoline. DarkSide's raking in $90 million a year offering ransomware as a service on the dark web. So as long as people are paying the ransoms and filling up the crypto wallets of these hacker groups, this trend is going to continue to rise. The good news is that we can combat these kind of attacks through basic processes and procedures that we're supposed to be following anyway, right? Even though Colonial Pipeline did pay the ransom, almost $5 million in Bitcoin, the software that they received from DarkSide to decrypt their files was moving so slowly that Colonial Pipeline restored from their own backups. So in the end, they really didn't have to pay the ransom at all, but that resulted in a 6-day shutdown of fuel delivery to a large portion of the United States. So while the ransomware attack on Colonial Pipeline that we just talked about did have an impact on U.S. infrastructure and its economy to a lesser degree, that was not the intent. DarkSide issued a public statement after that attack that said their motivation was purely financial. They weren't trying to attack the infrastructure of the U.S. And the fact is that the vast majority of cyber attacks we see today are not about nation-state cyber wars or political hacktivism. They're inspired by the same thing organized crime has always been about, and that's money. One more slide, please. I think we skipped one. There we go. So beyond protecting non-public information for altruism and protecting our customers, there's another reason we have to ensure we have a comprehensive prescriptive security program in place, and that's compliance. Most of us are beholden to FCCA or PCI, in addition to privacy laws like NYDFS out of New York or CCPA out of California. Even if you're not subject to one of those standards, the privacy law follows the data. There's certain criteria like, for California, you have to have a certain number of California residents' data in your systems to be beholden to it. But even if you're not even if you don't have a storefront in California, if you meet their criteria, you're still subject to their privacy laws. GDPR is the same way. If you've got data for people who live in the EU, you're subject to handling that data in the manner that the GDPR prescribes. These privacy laws are becoming more prominent. There's a big focus on them. A lot of states are adopting privacy laws, like the more stringent ones in New York and California. So if you're not paying attention to these privacy laws that are being adopted, it's probably time to. You may be subject to some of them. So how do we combat some of this? Let's talk about some best practices. This is really low-hanging fruit that we can use to most significantly move the needle in our security posture and defend against some of this stuff. Multi-factor authentication is huge. This is a big one, right? It doesn't help if we don't configure our systems right to enforce multi-factor authentication, but if we've got everything locked down where we're disabling old legacy single-factor authentication protocols and we're enforcing multi-factor authentication, it really does move the needle to stopping attacks against our email systems, which is one of the most common things that we see. Leaving legacy one-factor authentication protocols enabled, I see it all the time. It's been the root cause of probably of most of the business email compromise incidents we handled in the last 12 to 8 months, or 12 to 18 months. So MFA was enabled, but it wasn't being enforced. We were still able to compromise, or threat actors were still able to compromise our email accounts because they didn't have to have that MFA on. Next, please. Policies and procedures, documentation, all this stuff that never gets done because there's real work to do. These documents are how we make a process repeatable. It's how we make a process more efficient. The processes that come out of these documents are how we minimize impact to the business when we have to face down a cyber attack. So document your incident response plan. It shouldn't be tribal knowledge. It shouldn't be just the IT guy that knows how to respond to an incident. It should be a plan that you can follow. Document your backup strategy. This is how we recover from ransomware attacks. We isolate the threat, mitigate the damage, and restore from backups. Make sure that your disaster recovery plan is documented. Make sure you're testing all these plans at least once a year. Most of your compliance frameworks are going to require that you test them at least once a year. And keep in mind that the time it takes to execute all the steps in these recovery plans is directly proportional to the impact that an attack has on the business. And finally, we'll circle back to patching. Hot fixes, updates, that window of exposure metric that we talked about, we want to reduce that to something that's a reasonable amount of time so that it can't be exploited by somebody that can find your web app or your server on the internet. Make sure your vulnerability management program takes inputs from all these available sources, these penetration testing that we're required to do, vulnerability scans, system hardening benchmarks. These things all serve one purpose, and that's to discover the ways that an attack might be perpetrated on your infrastructure that give a malicious threat actor access to your data. We want to make sure that our vulnerability management program is not just discovering vulnerabilities, but also helping us to apply the patches and show us how we prioritize these things. All right. So just to wrap up, the financial impact of a cyber attack or a data breach can be considerable. Like the frequency of the cyber attacks that we see, that cost of a breach is trending upward. The good news is we can mitigate most of this impact by following security best practices. That's what all those compliance frameworks are meant to help us accomplish. So having a comprehensive security program built on standardized controls and maintained in such a way as to evolve based on the changing threat landscape we can effectively defend against and recover from most of the cybersecurity threats we currently face. That's all I have for the threat landscape. I'll turn it back over.
Awesome. Thanks to our speakers for those great presentations. I hope that you guys learned a lot about them. We do have plenty of time for questions and answers, so go ahead and pop in any questions that you guys have in either the chat or the question window. Just in case you kind of were a straggler, I'll go over the housekeeping items again, just to give you some time to enter in those questions. So today's webinar was recorded, and you will get the recording as well as the slides in the next couple of days, usually 2 business days, so expect that by Friday in your inbox. Feel free to share the recording and the presentation with anyone that you think would benefit from that at your company. It's just a really easy link to forward where they can download and view the recording and the slides as well. We'll have a quick survey at the end of the webinar, so go ahead and answer those questions. It really helps us guide the content that we cover each quarter. And this is part of a series, so be sure to join us each quarter. The information is always new, always changing. Everyone, you know, the topics change as well, just depending on what's happening in the landscape. So we do have one question. It's for Jason. Do you have a rule of thumb for email retention, i.e. all emails older than 120 days should be deleted or something like that?
Yeah, usually you're going to get guidance from the CFPB or the OCC or whatever compliance framework you're required to follow. Rule of thumb, we usually keep, I usually advise everybody to keep your email for a year archived. Now that's not accessible. That's just archived, and you can pull it up if you need to. You want to be able to access the last 90 days though. That's just a good rule of thumb that we've been using for a long time as a industry best practice.
Great, awesome. And we got another question for Jason. Do you have any guidance on the new CFPB requirement for IT audit standards?
For IT audit standards, I'll have to go back and look at the CFPB changes their regulations pretty frequently. They have no oversight, so they've kind of got carte blanche when it comes to what they want to write up in their standards and requirements. For an IT audit, it kind of varies by industry, right? So CFPB, only looks after financial institutions, and I'm not exactly sure what framework they're recommending. I'll have to go back and look at that detail. That's something I can follow up with the group on, but I would say it's probably going to be a standard that aligns with some of the frameworks like FCCA. That's one of the more stringent ones that financial institutions are beholden to. And those controls map fairly well to the other standards, even NYDFS and CCPA. Those recommendations or those privacy laws are gonna be covered if you're compliant with the FCCA controls. So that might be a good place to look. But I'll have to do some research and see if there's a particular audit framework that they're requiring.
I can hook you guys up by email after the webinar, and you guys can rap about the specifics.
Thank you.
Awesome. If anyone else has some questions, go ahead and type them in. Otherwise, we can probably wrap up a couple minutes early. Awesome. Well, thank you again for attending our webinar. If you think of any specific questions or want to chat about the content that we talked about today, feel free to reach out to us at info@richiemay.com, and we'll route you to the right subject matter expert to help you out with any of your, mortgage advisory, audit, and tax needs. So thank you, and we'll see you at the next Mortgage Trend Series.